Welcome back to the digital revolution, where we decode the intelligent technological forces reshaping business, economies, and global strategy, one episode at a time. I'm Jim Kunkle, and today we're stepping into a moment of reckoning. Artificial intelligence has become the crown jewel of innovation, driving breakthroughs in everything from predictive analytics to autonomous systems. But behind the headlines and multi-billion-dollar valuations, a question looms. Are we witnessing the rise of a transformative era or the inflation of a dangerous bubble? In our upcoming episode, AI Bubble, Boom, Bust, or Recalibration, we'll explore the mounting fears that AI hype may be outpacing reality. With tech giants borrowing billions to scale infrastructure and AI-heavy stocks dominating global indices, the stakes are no longer theoretical. We'll unpack the signals of speculative excess, the systemic risks to financial markets, and the ripple effects across energy, manufacturing, and digital sovereignty. And we'll ask the hard question: if the bubble bursts, what kind of recalibration will define the next chapter? Whether you're a novice, enlightened, investor, or innovator, this episode will challenge you to think critically about the future of AI, not just as a technology, but as a global economic force. Stay tuned. Bubble signals. The first signs of a bubble are often psychological, marked by euphoric headlines, gravity-defying valuations, and a collective belief that this time is different. In the case of artificial intelligence, we're seeing all three. As of Q4 2025, companies like OpenAI and Anthropic have tripled their valuations in under a year, with OpenAI now valued at over $500 billion, up from $157 billion just 12 months ago. AMD stock surged nearly 40% in a single day, following a multi-billion-dollar AI data center partnership with OpenAI. These kinds of single-day rallies mirror the dot-com era's speculative spikes, where investor excitement often outpaced fundamentals. The Bank of England has issued formal warnings about stretched valuations, suggesting that the market may be pricing in future profitability that's more aspirational than assured. What makes this moment especially precarious is the scale and concentration of investment. According to the World Economic Forum, the sheer amount of capital being poured into AI infrastructure, data centers, chip manufacturing, and cloud platforms is unprecedented. NVIDIA, the chip maker at the heart of AI model training, now holds more cash than the GDP of many small nations, prompting analysts to ask whether its valuation is sustainable or speculative. The bubble signals aren't just in stock prices, they're in the behavior of investors, the velocity of venture capital, and the narrative dominance of AI across media and boardrooms. If history is any guide, bubbles don't burst because the technology lacks promise. They burst when expectations become untethered from reality. And right now, the AI sector is floating dangerously close to that line. Debt-driven growth. The AI revolution isn't just being powered by data and innovation, it's being bankrolled by unprecedented levels of corporate debt. As companies race to build the infrastructure needed for large-scale AI deployment, they're taking on billions in loans to fund data centers, GPU clusters, and energy-intensive compute operations. Oracle, for example, has committed to a $300 billion partnership with OpenAI, a move that could require borrowing upwards of $25 billion annually over the next 4 years. This pushes Oracle's debt-to-equity ratio into the stratosphere, over 450%, far outpacing tech peers like Microsoft and Alphabet. Credit rating agencies have already flagged concerns, warning that the scale of borrowing tied to AI infrastructure could expose firms to long-term financial instability if demand doesn't materialize as projected. Private credit markets are also stepping into the spotlight, filling the gap left by traditional venture capital. AI startups raised over $100 billion in the first half of 2025, but that capital is dwarfed by the infrastructure costs required to compete at scale. Non-bank lenders now see AI as a $2 trillion opportunity, with private credit to tech swelling by $100 billion in just the past year. NVIDIA-backed Lambda secured a $275 million credit facility to expand its GPU operations, while CoreWeave and Nebius are borrowing heavily to build out their compute networks. The risk? If AI adoption slows, regulatory headwinds intensify, or energy costs spike, these debt-fueled expansions could become financial liabilities overnight. In this segment, we unpack how debt is driving growth and why the financial scaffolding behind AI may be more fragile than its technological promise suggests. Market concentration risks. The meteoric rise of artificial intelligence has led to a dramatic concentration of market value in a handful of tech giants, creating systemic risks that echo the dot-com bubble and 2008 financial crisis. As of late 2025, the Magnificent Seven of NVIDIA, Microsoft, Alphabet, Amazon, Meta, Apple, and Tesla account for nearly 40% of the S&P 500's total market capitalization, a level of dominance not seen since the peak of the dot-com era. NVIDIA alone has surpassed $3 trillion in market value, fueled by demand for its AI chips and infrastructure. This concentration means that any disruption in AI sentiment, whether regulatory, technological, or geopolitical, could trigger a cascading effect across global markets. When a few companies hold disproportionate influence, volatility becomes amplified, and diversification becomes harder to achieve. Beyond equities, this concentration is bleeding into venture capital, private credit, and even sovereign investment strategies. AI-focused ETFs are now among the most heavily traded instruments, and pension funds are increasingly exposed to AI-heavy portfolios. The risk isn't just overvaluation, it's overdependence. If AI adoption slows or fails to meet lofty expectations, the correction won't be isolated to tech. It could ripple through energy, manufacturing, education, and defense sectors that have bet heavily on AI integration. In this segment, we'll explore how market concentration is reshaping investment behavior, why it matters for economic resilience, and what lessons we can draw from past bubbles where too much power was held by too few players. Global economic exposure. The AI boom isn't confined to Silicon Valley, it's reverberating across global financial systems, exposing economies to a new kind of digital volatility. As nations race to integrate AI into their industrial strategies, they're also becoming entangled in the speculative dynamics of the sector. Sovereign wealth funds in the Middle East, pension systems in Europe, and state-backed tech initiatives in Asia have all poured billions into AI infrastructure, startups, and chip manufacturing. This global exposure means that any correction in AI valuations could trigger ripple effects far beyond Wall Street. For example, if NVIDIA or Microsoft were to experience a sharp downturn, it could impact national budgets, retirement systems, and public investment portfolios from Abu Dhabi to Oslo. Emerging markets are especially vulnerable. Countries like India, Brazil, and South Africa are investing heavily in AI education, cloud infrastructure, and smart manufacturing. But many rely on imported chips, software, and capital from AI-dominant economies. If the bubble bursts, these nations could face stalled innovation, currency pressure, and reduced access to global capital. Even energy markets are exposed. AI data centers are driving up electricity demand, prompting utilities to overbuild capacity based on projected growth. A slowdown could leave stranded assets and fiscal gaps. In this segment, we'll explore how AI speculation is becoming a systemic risk, not just for investors, but for governments, industries, and communities worldwide. The challenge ahead is building digital resilience that can withstand both boom and bust. Legacy lens. Every technological revolution leaves behind a legacy, not just in the tools it creates, but in the systems it reshapes. The current AI boom, with its soaring valuations and debt-fueled growth, is more than a financial phenomenon. It's a cultural and strategic inflection point. If this is indeed a bubble, it's one that reflects our collective hopes, fears, and ambitions for what intelligence means in the digital age. Like the dot-com era before it, the AI surge is forcing businesses, governments, and educators to confront deeper questions. What kind of digital infrastructure are we building? Who controls it? And what values are embedded in its design? From a legacy perspective, this moment demands intentionality. The decisions we make now, whether to invest in sustainable compute, diversify supply chains, or regulate algorithmic power, will shape not just markets, but the moral architecture of our digital world. If the bubble bursts, it won't just be a financial correction. It will be a test of resilience, vision, and leadership. Will we recalibrate toward inclusive innovation or retreat into risk aversion? For those building brands, institutions, or nations, the AI bubble is a mirror. It reflects how we define progress, how we manage uncertainty, and how we choose to lead in times of exponential change. In this segment, we challenge listeners to look beyond the hype and ask, what kind of legacy are we leaving behind in the age of artificial intelligence? Thank you for joining the digital revolution in unraveling this fascinating topic. Be sure to stay tuned for more episodes where we dive deep into the latest innovations and challenges in the digital world. Until next time, keep questioning, keep learning, and keep revolutionizing the digital world. And with that, I appreciate your continued support and engagement with the Digital Revolution podcast. Stay tuned for more insightful episodes where we talk about the latest trends and innovations in intelligent technologies. Until next time, keep exploring the frontiers of intelligent technology. Don't forget to follow this podcast series to stay up to date on the ever-changing world of digital transformation. Thank you for supporting the revolution.